So, look, I think the running theme of the past couple of days that almost every conversation has started with has been President Trump and his recent time in the region and in Doha. So that seems like, it still seems like a very relevant place to begin the conversation this morning. So to begin with, Mohammed, the QIA has obviously made this huge investment pledge into the US, and presumably your group in technology is going to be playing a big part in that. So can you give us some more color around how big you see the opportunity for investing into the US? How much of this $500 billion commitment do you see coming through your group?
Well, I think to start off, institutionally, QIA has always been underinvested in the US, and our CEOs have mentioned this several times in the past, and that continues to be the case. With this significant pledge to the US, I think it reflects the opportunity set that we see from a TMT perspective. AI as a theme that continues to disrupt to create a lot of opportunities, especially the case in the US. And there are several reasons that I'm sure everyone knows. The US has a large, significant end market. The US, from a tech perspective and an innovation perspective, whether you're looking at an innovation index or you're looking at the ecosystem, there's a lot of support for innovation, the research-led universities, and as well, just generally, the large R&D budgets, the US corporates. And I think this ecosystem supports the opportunities in the US. When I speak to many of the founders that are actively recruiting, when I speak to a lot of the companies that we get engaged with, I think there's one theme that keeps coming up, and which is basically the talent that exists in the US. And not just the existing talent, but the talent that the US is able to attract.
Yeah. And so where do you see the big opportunities for QIA now? Are you looking at, there's obviously been a lot of talk about data centers. Data centers suck up a huge amount of capital, but you also got the application space and the LLMs as well. So where are you seeing the place where you really want to start?
So across kind of the TMT spectrum, and we've spent a lot of time trying to understand how to approach the AI specifically as a theme, and starting from on the semiconductor opportunity. There's a number of inference chip companies that are trying to create a market for themselves within either on the data center side, on the training or inference. I think moving up, you have the data management layer. You have the likes of Databricks, which our CEO mentioned our investment in. On the infrastructure software side, there's also on the tooling space in general that serves the LLM and frontier labs with regards to data labeling, model development. We are actually looking across the board, and each layer within the opportunity set has and should deploy a different approach to our investing. So on the semiconductor side, we are using the VC method, given the high risk element when it comes to deep tech. And a lot of these companies are early stage, very R&D driven, and usually when they have a successful product, this does well and you see hyper growth. Moving across, I think the middle layer, the infrastructure layer, and the layer that on the tooling space that serves the LLM, I think a bit more stable, still has tech risk. As we move up to the application layer, I think is the most exciting because it's very observable. We can see the immediate value proposition on that application layer. It's also an area where we see a lot of growth and we see a lot of opportunities, and probably from an opportunity perspective, the largest in terms of numbers. A lot of those companies are very early stage. Some of them has evolved, but at each layer comes with its own risk and return merits, and this is something that has to be thought out and well researched from a due diligence perspective.
And Kevin, one of the headlines out of this region over the past few days have been $3 trillion heading in the US's direction.
Yeah.
A lot of that's going to be going into this space around AI.
Sure.
I guess the question is that AI is also absorbing a huge amount of capital. So is this enough money that is coming in? Do you see that? Or is it too much that's going to impact valuations?
Look, I mean, it'll certainly have an impact on valuations. Is it too much? No, I don't think so. I mean, look, we, by nature, as VC, we're eternal optimists, right? So we only see the upside. But we, I think we see this as sort of a generational transformation from a technological perspective, right? It's similar to the internet, semiconductors prior to that, and mobile as well. And so, we really see the opportunity as vast, and the capital needs are great. And I think there'll be plenty of opportunities for that capital. Look, like any industry, a lot of that capital will chase what are perceived to be the best opportunities, and so you will see valuations. And I think the ripple effects of that will be there'll be some businesses where you see some valuations that probably don't make sense. That's the nature of sort of the world that we live in. But we see it as a huge opportunity. There's huge capital demands. It's interesting, I think, a lot of that capital demand comes at the LLM and a little bit less the infrastructure layer. Where we really focus is, especially as things evolved, is at the application layer. And I think there we are, particularly around the point of valuations, very focused on capital efficiency, right? We're looking at opportunities where we've founders and management teams that have, a focus early on that go-to-market motion and that capital efficiency, because we think that's where the real value will be in terms of investment returns for our capital.
And I second Kevin's opinion. The demand for capital outstrips the supply. Despite the headlines that we see, there's a lot of demand for capital. You can throw in billions into data center. You can throw in billions on the application layer. I think the real question is, from an investment perspective, is managing the risk and constructing the portfolio.
Yeah. And Christina, can you talk to us a bit about, in a lot of this capital that we see people talking about coming in is sort of the equity investors wanting to come in and take equity stakes, but obviously there's a lot more to it than that. And you're very involved in also helping the whole capital structure come in to finance these projects. So how much appetite is there for the sort of debt products and more sort of structured financing around the AI build out?
Well, the good news is there's significant appetite, and there's been a tremendous amount of capital raised recently in what we call the private markets. And I think that is going to be a really important theme as we go forward. The $2 trillion of required investment that we hear about through 2030, the good news is there's a tremendous amount of equity capital to support it, but there's very efficient debt structured capital. And why that's relevant is many of these large companies, particularly the hyperscalers, while they have tremendous access to public liquid markets, the structured markets allows them to move some of this financing off balance sheet and get much more cost-efficient financing that's cheaper than their equity financing. And so when you look at, in particular, the infrastructure layer, I think a significant amount of that is going to be financed by this structured finance product. Some companies will rely on the public markets. Very highly rated, well-capitalized, large companies will go that route. But there's a significant number of companies, and our pipeline is growing pretty much weekly, where people are looking at these structured equity debt investment opportunities that are very compelling.
Yeah. And so what sort of returns should investors expect on that sort of debt side of things, and how does it compare to your traditional infrastructure project?
So I would say it's highly dependent on the structure and also the offtake arrangements. But a couple of the transactions that have been done in the past, the structured finance ended up being cheaper than equity, but actually relatively expensive because it didn't achieve the right, I'll call it, capital requirements. The most recent financing that we were involved with ended up being kind of in the sort of 8 to 9% range, structured off balance sheet, but very protected. And we had significant demand for what was $11 billion financing. We're looking at something right now where the financing requirements $35 to $40 billion. And we expect to be able to achieve the similar type of cost of capital for this very large client. So we couldn't be more excited about what I'll call the structured credit, private investment grade investing opportunity for our clients.
Mm-hmm. Mohammed, one of the things that came up in one of the sessions yesterday was this topic of sort of how to play the AI trade, and whether you sort of go in and taking equity stakes in this business, all these sorts of structured debt products. For QIA, are you mostly looking at the equity, or are you also looking at the sort of structured finance investments as well?
So we're seeing structure emerge in a few situations, but I think let's take kind of the data center. So on the data center side, so data centers is overlooked by our real estate team. So I don't, I'm engaged in those conversations, but it's not part of my remit. Within the remit of TMT, we're seeing obviously mostly equity raises, at least the good companies. There are companies that, either are the early AI cohort that are trying to navigate the complexities of how this technology is evolving, and we're seeing structure come up. Usually when structure comes up, it's scooped up by the insiders. So the insiders still believe in the company, they're backing the company, and they're deciding that it's not the time to have a valuation mark. Or it could be that this company is struggling and it's unable to find external capital. And that's when they would basically result in structure. So we're seeing structure, we're seeing the plain vanilla private equity raises as well. It really depends, it's a case by case. But I think those solutions are there to solve problems that are inherent within each individual company.
Yeah. And where do you see your focus being in terms of, are you really looking for that early stage new idea that you want to back, or are you also looking at mature companies that are doing sort of pre-IPO raises as well, or do you sort of think by that stage it's too late, we missed it?
Yeah, so from kind of a size perspective in QIA, we typically put in the first check as soon as companies hit that 1 billion mark and invest all the way up to IPO. And obviously on the public side, we're very active investors when it comes to co-invest and co-underwrites and any structured investments in public companies. So, but within the growth bucket, we decide, and we can trade off, the round at 1 billion for the round at 5 and the round at 10. And it's really a view on valuation and a view on the technology. And obviously the competitive environment that, is catalyzed by the disruptive nature of AI. Given the pace of innovation in AI world, we find ourselves, basically deploying options. So when I look at the application layer, or whether I look at, especially on the semi side, very innovative companies. There's a lot happening in semis. With AI, new materials are being discovered that solve specific problems, whether it comes to semiconductor equipment or in-memory compute and some of the accelerator companies. But there's risk. So as a portfolio manager, do I lead the round with 300 million? What we see, actually, for a 300, 400 million round, the lead is usually putting a 30 million check. Yes, and there's a long tail of investors that are following, and there's a few strategics, the NVIDIAs, the Intels of the world. On the other side, on the application layer, we're actually seeing the opposite. We're actually seeing the lead putting in 200, 300 million, i.e. taking 50+% of the actual round and a few other followers because they have conviction in the team, in the application. So it's different approaches, and the way we are approaching things, given that we are long-term, I need to put call options on the semiconductor layer, and I need to make sure that I diligence the ones on the application, the ones that I like. And one recent investment we have on the application side is Creste AI, using AI in the call center environment. Doug Leone, one of the founders of Sequoia, is chairing the board. So I'm just giving you one signal as to the conviction that Doug himself has in this name. That's not to say that we're not doing our own diligence. We are doing our own diligence. We are very thorough. We have evolved our teams and have specialized teams across the subsectors of TMT. We have a semiconductor and hardware team. We have a software service team, an internet media team, and a communications team. And I have 2 individuals specifically looking at China, because you need to speak the language, you need to understand the environment and the system there. And so in aggregate, the portfolio approaches, there are areas where you will put in kind of option value. There are areas where you will back 1 or 2 players within the application layer. And the easiest one, and sometimes it's due to how just how they've evolved, is in infrastructure with Databricks. There's a few handful of companies that operate in this layer, and it's the switching cost is a lot of friction. Yes, for a corporate to switch from a Databricks to some other legacy system or vice versa, there's a lot of friction costs, and there's scale benefits that these companies have and benefit from. Those companies deserve a premium, as we will see and will continue to see. Even when Databricks goes public, it will be trading at a premium versus kind of the long tail of the infrastructure software universe.
Yeah. And I mean, you mentioned, just a very quick follow-up, you mentioned you have 2 people looking at China, so you're still, I mean, as much as obviously, the US is going to absorb a lot of capital, you're still also looking at investing into China as well?
Yeah, so there's a few reasons why we look at China. We cannot discount China as a market. It's a very significant market. We are very long-term investors. Our view kind of it goes beyond the political state of the world today. The other element is if you're not active in China, you'll actually have mistakes in investing in the US. A lot of the corporate, NVIDIA has a large market in China. So many of the US homegrown based companies have markets in China. China is part of that ecosystem. When you look at robotics, the whole supply chain exists in China. It is yet to exist in the US. So understanding China is central to understanding investing in the tech universe in the US. I think that's the first point I want to make. The second point I want to make is, because China is somewhat closed off in certain parts of the market, there are opportunities in China that are for China in China. And for us, it makes sense to be active, to be looking at opportunities there. Obviously, we avoid situations where we could potentially jeopardize our position in the US, whether it's related to CFIUS or reverse CFIUS, that obviously we are very aware of. But it's hard to discount China. We saw the DeepSeek moment. When DeepSeek happened, I was actually in a plane going to San Francisco, meeting with the who's who in the technology space. And post-Liberation Day, I was in China. So just comparing and contrasting, being there, talking to people, and trying to understand how this technology is evolving. Yes, we will expect most of the innovation to come from the US, but there is talent that exists everywhere in the world, and I think the democratization of talent is going to happen because of AI.
Yeah. Kevin, can you talk as well a bit about, certainly in this space, America sucks up a lot of the oxygen in the room. Everybody's talking about that as an opportunity. Are people missing things elsewhere in the world? And how much time are you spending thinking about Europe as well as Asia?
We spend a lot of time thinking about Europe, frankly, a lot of time thinking about this region as well. I think one of the things that we expect to see is, look, early days, and we are still very early days in this. We have to remind ourselves, right? Like it's all we talk about, but we're really only a couple of years post the launch of ChatGPT. But I think, as the LLMs get commoditized and you start to look at investment opportunity more at the infrastructure and more so really at the application layer, the talent concentration that existed in the US coming out of research universities, coming out of the hyperscalers, I think that talent will get dispersed and get democratized. And I think particularly at the application layer where the capital intensity is more efficient and not such a need for large amount of capital is going to compute specifically, I think that will make it more accessible and diversify the talent base, frankly, across the world, right? You'll still have applications that are built that are focused on your large markets, US, I think Europe, obviously China. But I think in terms of where you'll find these businesses and where they'll start to pop up, I think we're looking beyond the US because I think we'll start to find more interesting opportunities as the technology and the talent becomes more dispersed and more accessible.
I also think it's interesting that 50% of the data centers are in the US, but that means 50% are ex-US. Europe, et cetera. And I think what's going on in this region is really exciting. And then you look at what is here in terms of energy, land, and engineering, research, and the focus on this region. We're very excited about that as well. Yes, the US is a significant place for innovation and entrepreneurship, et cetera, but it is, again, it's 50%, which was a surprising number to me when I looked at the data.
Yes. And how does that reflect on the time you spend looking at investments in different parts of the world? I mean, is that sort of half on the US, half everywhere else, or?
So, we run a global business at the firm, and our new capital solutions group, which is focused on really trying to, move the capital to places of interest. It's a very global business. I'd say I'd spend, half my time on the US, but the rest of it's now looking at Europe, this region, as well as parts of Asia. And I think we continue to be incredibly bullish that this is going to democratize. And it's super important for us as a firm to be supporting clients internationally and not being just very US-centric.
Yeah. So on that point, Mohammed, for the region, a lot of what came out of Trump's visit was also about getting access to chips and also partnering with US firms about building data centers in the region. I mean, how much are you seeing the GCC as becoming a global AI hub? and not just a regional one?
So chip access is definitely a win-win. For the US, a win for this region. I think the important thing to understand with this region, and maybe not many people know this, but 30% of global internet traffic goes through the Suez Canal. Mm-hmm. And if you aggregate the traffic that goes kind of across the Middle East, including the Suez, I think that number could go easily up to 40, 50. So the region is very central. The region has a lot of relatively cheaper energy because of for example, in Qatar, LNG, and there's a lot of sunlight and solar, as everyone would know, and we're strategically located. The added benefit that this region has is this region was relatively late to the cloud transition. So we don't have legacy systems and software to deal with, which actually creates fertile ground for this region to leapfrog. Leapfrog Europe, leapfrog the US, potentially. And I think being a strategic partner with the US, and I mean here by the region, mm-hmm. there's a big opportunity to play a much important and bigger role when it comes to compute. And we've kind of analyzed where Qatar is situated vis-a-vis these population centers. And Qatar is very strategically located. It's within 1 hour from the capitals within the GCC. And we've also looked at latency numbers from Qatar all the way to India. And within the sub 30 milliseconds. So on that, I think, metric, Qatar or the region can actually serve India if need be from an inference perspective. And so Qatar can, and the region can serve the region when it comes to the demands of compute.
Mm-hmm. And Kevin, have you looked around at the Middle East? Are you looking for opportunities to invest in this region?
Yeah, we are. I mean, we are. We've been over a few times in the last year, or spending more and more time getting to understand the region. I mean, one of the interesting things that we find here, actually in contrast to Europe, is the regulatory framework, even across the GCC countries, actually makes, even though it's a smaller market, it actually makes it a little bit easier to navigate than Europe. You don't have some of the regulatory complexities that you see. It's obviously a very fast-growing market as well, which is always an exciting opportunity for us. And so, yeah, we are spending more and more time trying to find opportunities, looking to find opportunities in the region.
Yeah, and how, for the investors that you speak to as well, I mean, are they also wanting to get exposure to this region?
Yeah, no, look, I think there's a lot of interest in this region, and I think that's only going to increase. From a relatively US-centric business, it's only going to increase with this visit last week, and there's a lot more attention, I think, being paid to the area. And I think more and more our LPs are interested in seeing opportunities to deploy capital through us into businesses in the area.
Yeah. Okay. Well, the clock is ticking, and we just have a few seconds left. But so I will just hand it back to Mohammed as our host to have the final word. So you've obviously brought in a huge amount of investors from all over the world to Doha for this event. I mean, what would be sort of, the key message that you would like to leave people in terms of that opportunity that there is for investing into the GCC and investing into Qatar to help develop the AI ecosystem here?
I think definitely engage. You can read Bloomberg News and you can read headlines, but you will never get a feel for how to do business in this region until you actually create long-lasting relationships. Engage with people, speak with people, discuss. They will call you back and ask you a question. There's a lot of knowledge to share across the globe, and I think this is important in building those relationships that hopefully would translate into win-win business arrangements.